Welcome to Chit Chat Stocks, the podcast that helps you discover your next great investment. I'm one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. If you are new to this show, if you're a new listener, first of all, thank you for tuning in. If you are listening on anything other than your podcast players, please give us a follow so you never miss an episode. We have a full content slate today. This is our weekly Power Hour episode that we do live typically on Thursdays at 5 p.m. Eastern time, but we're doing it a day early. And we have everything from I think the largest take private deal of all time in Electronic Arts, a stock I think Brett and I both used to own. We've got Agentic AI. Shopify is collaborating with ChatGPT. And then Brett and I are going to be going through our top never sell stocks. We can kind of maybe talk to some news first and then hit that. And then we've also got some earnings as well. Nike earnings, the apparel giant that seems to be crumbling before our eyes. But Brett, where do you want to start?
Oh, it's a good question. Thank you to all the listeners for joining this week. Hopefully, you have a good show. And if you have any questions, join the live chat as well. I was told last week, Ryan, that you didn't want to do any more AI talk, but I guess this is a loophole. There's something productive we can do here because Shopify is getting used by ChatGPT. I saw some very, very hot takes that this was going to disrupt Amazon. So why don't you go through what they are doing, how it affects the e-commerce world, and then we can give our thoughts.
Yeah, and let me clarify because someone did ask us to talk about this. The topic I am tired of talking about is the ROI on AI CapEx. Because I just don't think I'm going to have any brilliant insight there. But some of the applications and how it affects individual companies and certain AI use cases, I'm more than happy to talk about. So, a little bit on in terms of the details of the partnership. So, OpenAI released a press release as well as Shopify this week that they are partnering with both. OpenAI is partnering with Etsy and Shopify to power direct shopping from within ChatGPT. So here's a quote from OpenAI's press release. It says, US ChatGPT Plus Pro and free users can now buy directly from US Etsy sellers right in the chat, with over 1 million Shopify merchants like Glossier, Skims, Spanx, and Vuori coming soon. So for people imagining what this would look like, it's really not that complicated. I watched a quick demo. Basically, it's just native checkout within ChatGPT. It's kind of like Instagram shops in a way, where it's just keeping you on the platform, but sort of shop within
Wait, so
the
you have to
platform.
still you have to still put your payment details in?
I think it can be auto stored in ChatGPT.
Okay, but you just tell it, can you communicate with it with a sentence and say, hey, why don't you can you buy this, what have you? And then it goes and does it for you, or do you still have to go through a step-by-step process?
I'm not sure that was not displayed in the demo. The demo was something like, show me a bunch of options for ceramic bowls from that are less than $100 that are for my friend, whatever. And then it gives you options. You click on it, takes you to a checkout page, you pay.
I've already
So
done that with Gemini.
yeah. Uh,
Huh.
does it redirect you to a separate website?
Well, maybe, but you can get all these listings. Like, I'm looking at upgrading my laptop for work, and I've been doing a bunch of comparisons. I said, hey, with these classifications, size, I want a bigger one, blah, blah, blah. It gives me the listing. So I'm not sure what sort of innovation this is, but maybe it's the fact that it's through Shopify payments. I'm not sure. Again, I saw people saying this was going to kill Amazon. I think if the shopping experience is what mattered, Amazon would have been dead a long time ago. It is much, much more difficult, I think, at least, to search on Amazon versus maybe even through Google, or probably like the Shopify application, or even through social media. But Amazon has the delivery network, and I think the follow-up question I'd always ask my AI, whatever one you're using here, ChatGPT, Gemini, or any others, is, well, how can I get this delivered the fastest? And then he goes, well, if you use Amazon, it'll get delivered the fastest. Okay, boom. I'll have it tomorrow instead of in 2 weeks.
Yeah. I can't imagine that people are like, well, now that I can buy it through ChatGPT instead of searching it on Google, I'll gladly take a 1 month delivery time instead of having it by tonight. So I think anyone that believes this is going to disrupt Amazon doesn't necessarily understand the competitive advantage that Amazon has, which is entirely in its broad selection and delivery. So,
And
uh,
we're forgetting about Rufus.
and
You know,
Rufus, I guess. No,
gotta
this,
love Rufus.
I
You can
think
still,
this
I mean,
is,
that's I'm being somewhat joking, but you can already do this on Amazon with their hilariously named, bot called Rufus.
yeah, I don't think much of this. I think this is two companies that love press releases doing a
Yep.
partnership together that makes things maybe a little easier at the margins, but uh, it's not that different than having them redirect you to a Shopify website. Like, the user experience is not really that different other than maybe you're saving a click or two. So, it can populate ideas for you, but I believe it was already able to do that to begin with. So, I don't think this is a bad thing for any of the people announcing the partnership, OpenAI, Shopify, or Etsy, but I would not blow this out of proportions. N Yes, this could become a viable avenue for more e-commerce in the future, like more, maybe there's more commerce done through AI chat interfaces, but it doesn't actually change the chain of, uh, companies in that process. Like, it's still you're still going to go to a Shopify site, even if it's embedded within ChatGPT, you're still gonna use the Visa payment rails, you're still gonna use a Shopify, uh, whatever their Shopify tracking app is, and if you want quick delivery, it doesn't matter, you're going to Amazon. So, yeah, I don't think there's that much to talk about here. I guess it's a positive if you're an Etsy or a Shopify shareholder.
Yeah, it can't be a negative, but who knows? All right, let's talk Nike. They are good holdover stock for the in betweens for the earnings season. They reported this week. I'm looking at the stock right now of 6.5% today, Ryan. Coming off a bit from the lows, it's actually up 15% in the last 6 months. We're at about $74. And if we look at the lows in the spring of this year, it was getting close to $50. So, what happened? Take us through the earnings, and then we can talk about how it affects my psychological long in Lululemon, right? We can use the transitive property there. But yeah, go through the numbers and what stood out to you in the report.
Yeah, any positive response in the stock price must have been from commentary on the call or something like that around basically strategic moves because the results were definitely nothing to write home about. So,
Well, expectations. Stock's down a ton from all-time
sure,
highs.
yeah, I mean, the expectations were horrendous and the results were slightly better than those horrendous expectations. But in a vacuum, you look at these results and say constant currency revenue growth was minus 1% for Nike. They have not grown virtually at all in 5 years. Apparel, footwear, both struggling from a competitive standpoint, and footwear specifically, they are losing share to On Running, they're losing share to Hoka's, who both continue to just chug along and grow every quarter. And then on top of it, they reported their last 12 months is the worst gross margin that they have had in 20 years because they have had to discount all of their inventory heavily in order to sell through it, which raises some questions about brand impairment. Like, Nike is seen, I think Nike is seen as a premium brand, maybe because of the years and kind of heritage they've built around athletic premium apparel, but also because it's been fairly expensive. So, what do you think of it as the price drops? I don't know if it impairs it as much as everyone thinks. I still think if I can get Nike 25% off compared to normal prices, I'll take it. I still like the brand. But there is some questions about brand impairment. So all this is to say apparel in general is struggling a bit. So we've seen this with Lululemon. So it's not like Nike's isolated. Footwear, they are losing share, and that's something to watch and monitor, but they are still the 500-pound gorilla in the room when it comes to footwear. Like, even if you combine Hoka and On Running, they don't come close to Nike's footwear revenue. But they there needs to be a turnaround at some point, especially in the margins. Like, the gross margin pressure is what's leading to has led to the stock selling off so sharply. My question to you, I guess, is there anything that would get you interested in owning Nike, or is this another prime example that never invest in apparel is a good principle to have?
I think it would be very tough to get me to want to invest in Nike, given its size, given its existing market share, and given its exposure to China, where you're seeing local brands do quite well over there, and I have no read on whether Nike is going to make a comeback there or if they're going to go to zero in that market because of these other ones. I think it's called Anta, maybe some other ones. Again, I don't know much at all. Lululemon does interest me because it's one cheaper than Nike, I believe, on earnings ratios, and two much smaller. I think I can get a little bit of a better read on that they're not totally dying in the United States, and that's 70% of their business. Well, United States and Canada. So compared to Lululemon, no interest whatsoever in Nike. Too big. You kind of look at it and go, well, how does this stock go up 10x for me over the next 20 years? It's kind of tough. Market cap's already $100 billion. You already have so much market share. You have a lot of competition in the apparel space. It's not going to be a winner take all area, and it takes strong brand management. I think it's an easy pass for investors.
Yeah, I couldn't agree more. And this is a company that has missed its targets for
For a
like more
long
than a
time.
decade.
Yeah.
Like, if you go back to their old
Yeah.
investor presentations, they threw out all these lofty growth assumptions and they got a premium for it. And it's like no one ever held their feet to the fire because they missed those every single time. And our friend Alex Morris does a lot of good writing on Nike, covers them really well, and he talked
At
about it,
the what's the name of his service for
the
people that want
science
to
of
know?
hitting,
TSOH
TSOH, sorry,
investing research
TSOH.
service, yeah.
The Yeah, they've been chronic underperformers of their own expectations, and I agree with you. Like, if you are banking on an apparel turnaround, I think the probability of an apparel turnaround is similar for Lululemon and Nike. Like, all the if growth is gonna start coming, I think it's gonna happen for both, would be my expectations. I don't see why one is significantly better positioned than the other. I think they're both kind of similar premium athleisure wear.
Well, the one thing you could argue is that Nike has much more exposure to footwear and Lululemon is much more exposure to premium athleisure clothing. That's the only difference, but besides that, yeah, I agree.
Right now, I might take apparel, between those 2 categories because it seems like footwear, Nike's really struggling, but the my point is, both of those seem like a somewhat risky bet. You're banking that this is not the beginning of a downtrend and sort of the erosion of their market position. But if I'm gonna make that bet, I would much rather do it at 8 times EBIT, which is what Lululemon trades at, than 30 times EBIT, which is what Nike trades at. So, like, you're not getting paid for the risk, in my opinion, on Nike.
Well, I agree. Okay. Do we want to talk EA, Ackman's shareholder letters, or the Texas Stock Exchange?
I thought the Texas Stock Exchange stuff was pretty interesting. Let's save Bill Ackman and maybe some of the other headlines for after our never sell discussion. Do you wanna go through the Texas Stock Exchange news?
Yeah, I think the general can wait. Texas Stock Exchange. It's going to be called TXSE. I think they're supposed to call it Texi, which I'm going to veto that. We're not going to be calling it that. The Texas Stock Exchange makes sense. I wrote down that this looks like a moat test for the New York Stock Exchange and NASDAQ. Here's a quote from their press release. The Texas Stock Exchange received approval from the Securities and Exchange Commission Tuesday to operate as an exchange, paving the way for the Texas Stock Exchange to start listing shares next year. Hand up. I did not know this was a thing. Apparently, it's happening in Dallas, and they were inspired by quote unquote onerous regulations at the New York Stock Exchange and NASDAQ. I don't know if that can be, if I, they're being honest there, because there's a whole trend of just Chinese fake companies getting listed on the Nasdaq, and if they can get listed, pump and dump their shares, and get out, which happens quite frequently, are we sure that there's onerous regulations to get legitimate companies from the United States onto the Nasdaq? But I guess that's a whole nother topic. The first approval, this was the first approval for a national securities exchange in decades, which kind of shows the moat from the New York Stock Exchange and Nasdaq that they have had. There is backing here from the Texas Stock Exchange from BlackRock, Schwab, and Citadel. Here's a final quote I have. Texas Stock Exchange will launch trading as well as ETP and corporate listings in 2026. Over the long run, Texas Stock Exchange's mission is to reverse the decades-long decline in the number of U.S. public companies by reducing the burden of going and staying public while maintaining some of the highest quantitative standards in the industry. As an investor, I like that. More stocks out there, the better. Better for the show too. We can talk about more companies that are publicly traded. Now, what do you think here about if you were a New York Stock Exchange shareholder, NASDAQ shareholder, whatever respective companies they're under? Would you be concerned at all here? Because I look at this backing, BlackRock, Charles Schwab, and Citadel, and if they weren't there, maybe I wouldn't care, but those are three huge players in the industry that could kind of get momentum going for a third player in this duopoly.
I don't know if I'd be a seller if I were an owner of the New York Stock Exchange or Intercontinental Exchange as the parent company. I wouldn't be that worried yet. I certainly wouldn't be discarding shares of an operation that's withstood 100 years of operations, but I like this. We actually talked about this a year ago, Brett, I'm pretty sure, on this show when they announced that they were going to try to build these efforts.
Get an approval? Well, my memory's not serving me well there.
The I if it leads to more companies coming public, I'm okay with it. I have heard before a lot of companies complain about the requirements to list on the NASDAQ and the NYSE. I just took a quick look and there are like obviously there's listing fees, so those can be expensive depending on the size of the company. Not only there's an initial listing fee, but then there's like the annual recurring listing fees, which if you follow the New York Stock Exchange business model, you'll see that in their KPI reporting. But
Sounds
apparently
like a good business to me.
the big one is they're pushing certain corporate governance standards on all the companies. So e I think this might push
ESG stuff, a little ESG.
you have to have a compensation committee.
Stuff like that.
So I imagine you're probably not the biggest fan of that. We've talked about the
That would
pointlessness
be,
of
yeah.
compensation
Let
committees.
let's get rid of that requirement. That just seems to be a scam for the compensation committee companies. If
Yeah.
if there's no requirements on, say, all the stuff that no one cares about on the proxy statement, such as ESG and, frankly, the as an investor standpoint, the diversity stuff that some people that I don't know if they require that, but then also these compensation committee things, maybe that is for the best, and maybe it'll convince the New York Stock Exchange and Nasdaq to lighten the load on stuff that doesn't really matter from a public company standpoint. What we do care about is just that your accounting is legit. That's it, right? Do we care about anything else?
No, that's the big one. But it just my question is it really the exchange's role to enforce that, to enforce all this stuff? Like if they pay their fees and they're in good standing with the governing body for accounting, so the SEC and the
Right.
why am I blanking on the organization that collects my taxes? The
IRS.
the IRS. I was thinking
Yeah.
IRA. The Yeah, I mean, if they're in good standing there, I just don't see why it's the exchange's role. But I'm looking I asked ChatGPT, why do companies think there's such onerous requirements? And there is just a ton of stuff to be compliant with all of the NASDAQ and NYSE's thresholds. There's also financial thresholds. So a lot of smaller companies just simply can't do it or it's too costly to be on there. So I'm for this. I hope it works out, but I would say prove it. Let's wait and see. If
Well, the
I'm
mode test the mode test is probably gonna work out fine. All they gotta do is just not be so onerous with these, requirements, and then why would anyone wanna list on the Texas Stock Exchange? Also, you can list on in multiple places, so I still think trading will be centered on New York. I mean, yeah, it's been around since 1790. I think the New York Stock Exchange and Nasdaq is much newer, but I think the New York Stock Exchange is gonna be around for at least a couple more decades. It's not gonna kill their business,
This will be a good moat test, though. You've got
for
phenomenal
sure.
backing. BlackRock, Schwab, Citadel. I can't think of a better name brand backing to have if you're launching a stock exchange, not to mention the probably insane liquidity that they are willing to throw at it. So, yeah, if you're a holder or a shareholder of ICE, Intercontinental Exchange, ICE is the ticker, and this ends up being absolutely nothing and not putting a dent in the business, I think you should feel even more comfortable owning those shares. Let's talk never sell. Our never sell companies. How do we want to do this? Do we want to do it as a draft?
We can, or we can basically do our rankings. Is it if it's just from our existing holdings, there will be some slight overlap, but I think coming up with a ranking or just a list of companies that are never sell stocks. What exactly, before we get going, let's talk about why we're doing this, what a never sell stock is, and how it's helpful for us, the philosophy as an investor.
Yeah, this actually forced me to think about uh, it forced me to look at my portfolio, and there are certain companies that just in the back of my mind, I never think about selling. I'm kind of unless the stock goes up like 100x or whatever, or 10x in a year or something in really short order, it's unlikely that I'm even going to look at it
Yeah,
as a sell candidate.
it enters the Shopify Palantir zone.
Right.
That's essentially how I think about it.
Yeah. The so it, I had to ask, like, why do I think that way? And basically, the answer that I came down to is it has nothing to do with the type of business that they're in. It has nothing to do with the size of the company. So I think never sell companies come in all sorts of shapes and sizes. You could have a $1 trillion market cap world leader in e-commerce. You could have a Canadian vertical market software serial acquirer. I think people know who I'm talking about. Or you could have a small cap student lending company. There isn't any one type of business for me that determines whether or not the stock is a never sell. The theme that all the companies have in my mind that end up being never sells is that management treats it as a never sell. So oftentimes that requires the company to be founder led, but when the person running the company has no intention of making money fast or hitting short-term hurdles, they end up making choices for the business that they think will help shareholders the most over the long run. And that's where I want the alignment. And I don't want to be trading in and out of that kind of thing because if they are thinking ultra long term, if they think of themselves as never sell shareholders, I feel a lot more comfortable calling that a never sell as well. It's when my time frame is mismatched with management's time frame that I it doesn't qualify. It doesn't end up in the never sell camp for me. What do you think is sort of your criteria?
I think that makes sense. It's when you're uncomfortable with their time horizon that that can make you uncomfortable as a shareholder. if you have that alignment, you can have that comfort quarter over quarter over quarter, not really worry about where the stock is trading at. I think I could sum it up in two criteria for myself. One, management and culture, which just top notch management and culture from an investor standpoint, from the fact that they think long term, do rational capital allocation, all the things that you'd care about. And then second is a wide moat business. Those are the two things. As long as there's a wide moat, whatever it is, I can be confident in the durability and holding through whatever market cycles gets thrown our way.
I th- I think I could. I'm going to talk about a company here that's on my never sell list that I would not describe as a wide moat. So wide moat helps, but I could end up calling a company a never sell, even if it doesn't qualify necessarily as a wide moat. But
Okay, well, let's go through our existing holdings. Again, these had to be ones that we actually own, although there could be some others on the watch list that we might buy at the right price. Let's go through our never sell. I think if we just list them, I don't even know if I could rank these. They're kind of just all in the same category.
let's alternate. Let's alternate.
Okay, let's
I'm
just
curious.
alternate one by one. Just choose them. I think I have three. Well, I think I got four. I have four from my existing holdings.
Okay, go first because I got three.
Okay, first up, we're just gonna go from the bottom of this fiscal AI dashboard to the top. Nintendo. Even though I said I'm going to
Interesting.
sell at the end of this year at 30, I think that's just probably a trim. And that's kind of just a prediction we made for our annual predictions episode. It is a culture and management that thinks long term. Some may say too long term when they get impatient with what the company is doing. And I believe it's a wide mode business in entertainment. They nurture their brands. They don't oversaturate their content out there. They have been the premier video game player, especially for family friendly content for a long, long time. If you have any sort of bullishness on Disney, you should be bullish on Nintendo and their durability because I think they are much, much more durable and have all the characteristics for a never sell business for someone that can go, look, I'm going to buy this. I'm not going to think about it for 40 years. And I'm going to be fairly confident the result will be adequate.
So that one kind of surprises me. Not I agree. It is a management team that thinks insanely long term. They've been around for more than a century now, and they care so much more, I would think, about preserving their brands than maximizing profits. The only thing that would maybe not qualified as a never sell for me is that it's still fairly event driven in terms of like product events or drive certain moments for the company and financial results. So I could see myself uh the stock trading wildly around certain events and that leading to potentially a sale decision for me. I'll go with my number one, although I do think that's a good pick. My number one is Coupon. They are the e-commerce leader in South Korea, and I think they're hoping to become the e-commerce leader in Taiwan as well. The founder, Bom Kim, has significant insider ownership. I think it's around 70% or more of the voting power. I should probably double check that. But he he runs this company. It's his company. He is bought in for the long term and seems to make decisions based on maximizing value for the business 5, 10 years down the road, as opposed to maximizing value today. And you see that really with the CapEx investment and the infrastructure investment, much like Amazon 20, 15, 20 years ago, and even still today, where they continued to, they were relentlessly focused on how do we serve the customers as best we can. And Bom Kim has unapologetically copied that mantra. And he actually talks about being looking up to Bezos and trying to copy his model and be customer obsessed. So I like them. They continue to make investments today that could hurt margins in the short term, but will benefit lifetime value of their customers over the long run.
Okay, that's a good one. I own it as well. I guess I didn't put it on my list, but could you put it on there too? I could easily include in my never sell portfolio. My second one is going to be Interactive Brokers. We've done, I think, one, maybe multiple research report episodes and newsletters on this one. I bought it earlier this year. So go check out that research report if you want full details on the business model and all that good stuff. They do have the founder, the insider ownership with the founder, Thomas Petterfee. It's actually a great profile of him on Colossus. I think it's called Colossus Review. It's a free profile. It's really great, and it goes through basically his life and his philosophy around business management, although he has passed off the day-to-day management to a current CEO named Milan Galik. And there's some funny stuff within that interview where people compared IBKR to Costco with the scaled economy shared model. They lower the cost for all the customers, and they try to really just keep things as efficient, bare bones on the back end as possible to drive costs lower, make it a better product for their professional investor base and even individuals like ourselves. And then they can have those lower costs, it leads to better profit margins, then they can reinvest into even more technical cost savings. But when he was asked about that, he actually, and I guess he's older and also an immigrant, so maybe he, and he's also very rich, so he hasn't, lived the middle class American life. But he didn't seem to know what Costco was, which was hilarious. And he said, "Yeah, I've never been to a Costco, and I don't read business books." So he just kind of passed it off like, "Yeah, I don't really care." So Costco,
That's kind of
I guess
insane that he doesn't know what Costco is.
he's a strange guy. And it takes that eccentricity to become one of the first electronic market makers, come up with interactive brokers, and create a business that is so automated and efficient in the brokerage space that you have better profit margins than Visa and MasterCard. It was also interesting, and we do love interactive brokers as a sponsor, is he said he has gone, his new goal is because they want to expand their user base, is he's now in charge of marketing. And he says he's tackled that. So that's who we're technically dealing with when getting new podcast sponsors, which I thought was kind of funny, cool, but also a bit intimidating, given that he's kind of an intimidating man.
Well, he's welcome to join the podcast whenever he wants.
Yeah, whatever he wants. You can promote IBKR all day to our thousands of listeners. But when I look at IBKR, its valuation today, PE is 36, definitely not on trough earnings. Because if anything, we're on peak earnings. If this is the bubble that some people think we're in, if not, it's 100% a bull market, and that helps their trading and their revenue. But I don't really care because I know they're going to deal with the market cycle perfectly fine. They're going to come out strong on the other side, and as they keep gaining users, they should grow over the long term. I'm comfortable with never selling this. I think the only way I would sell is if the PE got to 100, 200, maybe I would trim, but I just see no reason why I need to sell this. It's an incredible business. I think it's one that's going to stand the test of time and can be an easy, durable winner in your portfolio for if you have a decade, 10 to 20-year time horizon.
Yeah, this is a good example of actually seeing the never sell in practice because would you buy if I quoted you that earnings multiple on potentially peak earnings today?
No,
Probably not,
definitely not. But I bought at 40 in the spring.
but
Now we're at 70.
you're nowhere near selling. So it kind of goes to show that it belongs in that camp. Okay. And the other thing I want to follow up on there is they are a company that has continuously driven down cost and or driven down cost for the customer. So driven down prices. It is actually so rare that you find a company that their true intention is to drive down their price. Like people we as investors, we talk about the examples all the time and how it's so beneficial, and Amazon's done it, Costco's done it, IBK are like very successful companies have focused on driving down price. But those are so rare relative to most companies out there. And I would I challenge someone to give me an example. There probably are some out there, but give me an example of a company who has made it their mission to drive down price that is not founder led. That it's a mercenary CEO who's come in and said, all right, we're going to do as much as we can to drive down price. I don't think there's a lot of examples like that. So that leads me to my second company who intentionally drives down price, Wise. Wise for me is probably in the never sell camp. Once again, huge insider ownership. They constantly they talk about trying to take cross-border transfer fees to 0%. They really want their fees to be nothing. Their mantra is money without borders. That's pretty rare, and that's why they've been able to drive such significant user adoption. My only concern is that maybe something happens in the corporate culture, or I just haven't owned the business for a long time since they haven't been public that long either. So there's still room for them to surprise me in a negative way, which would maybe lead to me selling. But
We can call it a future never sell candidate. I like this choice. Founder seems to do the same thing. There are people that compare IBKR and Wise a lot, and I kind of agree. Um,
yeah, the founder treats this like a never sell, which makes it that much easier for me to treat it like a never sell. But yeah, I'll leave it
the
at
Europeans,
Wise.
the Europeans, they got longer
True.
time horizons sometimes than the Americans.
Yes, they do. All right. What is your third company?
All right, I'll do this one for my third, and I think I'll say the last one for either one that I know you're also going to pick, but I think listeners kind of know if they've been a long time listener of the show, both of well, my largest holding. My third one, and again, it's one that some people do not like. It is Airbnb, founder led, founder mission led. We talk about the eccentricities of the founder, Brian Chesky, and how that can be good and bad in regards to wasteful spending. But he says he's going to be at Airbnb for the long haul. I think they have a long term plan to become a can't miss travel, lodging, and perhaps experiences platform, although that's a TBD there. But either way, I think this is a wide moat business with management with a long term time horizon. And if Airbnb stock went up to what you would call a bubble PE ratio, however you define that, I don't think I would consider selling whatsoever, and except for trimming on that, sleep number percentage of the portfolio that David Gardner talked about with us.
Yeah, this one I would also call a never sell, but for a little bit of different reasons than some of my other companies. For Airbnb, I think the upside potential is so high that it's almost like a hedge against my own stupidity of I don't want any risk of this becoming a 50 bagger or whatever. And I sold early because I got fed up with stock-based compensation or whatever. So it's almost like I have the never sells that I really appreciate management and culture. And then I have the never sells of the upside is so high, just don't touch it, don't look at it because you're just going to get in your own way. That's probably where this qualifies for me.
Yep. Yep. All right. What's your last one?
Last one for me, I think this is the one you knew I'd be talking about, and it doesn't have a moat, I don't think, seeing as it's basically
Culture moat. Culture moat,
sure it's
right?
a culture moat. The
Yeah.
company is Nelnet. This might be the longest I've held any company. Actually, they're one of the first companies that I still own that I found. I think the original person that brought it to us was Jim Gillies, an investor we both really admire, and this is sort of an oxymoron, but a mini conglomerate where they've got
Small cap. We'll call it
it's
small cap.
it's a small cap
Should be large
and
cap once if the value got unlocked.
sure, yeah,
Sorry,
that's
keep going.
that's the goal. No, they own a student lending operation both on the servicing side as well as the they don't originate anymore, but it's a big student loan portfolio that they continue to reap the cash flow from. And then they're diversifying that into a variety of businesses, probably the most notable being their Nelnet Business Services, which is, or I believe that's their naming for it, but it's basically education software, which does seem to be quite sticky and it generates a good amount of income each year, but it's not like I'm not in love with the company for the business specifically. I just really like management's capital allocation skills and the way that they treat shareholders. So they've grown book value per share, I think, at around 16% annually over the last almost 20 years now. And they constantly understate the value of the assets on their balance sheet. They constantly make investments that masquerade profitability because they don't care about maximizing profits in the short term, and often they don't maximize profits in the short term.
Well,
Uh,
stated profits, yeah, they like to avoid taxes legally,
yes.
John Malone style, and that can make the earnings look worse when in reality they're generating significant value for shareholders.
Yeah,
And
it's
that's
one of
great. I mean,
those.
long-term time horizon, capital allocation, track record, skin in the game. Everyone stays at the company for a long time. Midwest too. You're not in San Francisco, LA, Miami, or New York. I think that can be
Somehow they're
helpful.
not getting the Midwest premium though that some other companies seem to get.
That's
No,
all right. They've reduced. Let's actually find it quick on Fiscal AI and see what they've reduced their shares outstanding at for the last like 15 years, whatever the number is, because I would rather have them trade at a consistent discount to the sum of their parts because they're
sure.
just going to take that shares outstanding down with all their excess cash flow. Let's look at their shares outstanding. 54 million in December of 2005, which is right around the time of their IPO. 36 million today, down on average 2% a year, which might not seem like a lot, but they're paying dividends and reinvesting at an insanely high rate. All the excess earnings they're generating from their financial services, all the stuff that Ryan already talked about, we've talked about before on the show. And that's a cumulative change of negative 33% from 2005 to today. I mean, that really can add up to long term returns. If they can do the same or even slightly better over the next 20 years, that's how you turn a company from a 10 bagger into eventual 100 bagger.
Yeah, and it's one of those where the chairman, I believe he's still the chairman, Michael Dunlap, who is still involved from what I can tell. He's not the CEO and running the day to day, but he's still involved on some of the capital allocation, I believe. It's He has made it sort of his life's work and his life's project, and he treats shareholders fairly. And like you said, you get comfort in knowing that if this were to sell off, like let's say you buy it at a valuation that you think is fair, maybe it's not dirt cheap, but it's fair. If this does sell off, they will capitalize on it. When you have a management team that thinks long term, they're going to capitalize on a poor valuation. They're not going to, oh, I'm going to get jump ship and go to the next company that can give me a nice signing bonus. So, yeah, those are my three: Coupon, Wise, and Nelnet. Did you have any honorable mentions that weren't talked about yet?
Well, I would have had Nelnet as well. I was thinking of putting the Mexican airport in there, but maybe 2048 is the never sell. I love when people always say, "Well, what happens in 2048 when their contract ends?" And I go, "I don't care. I'm going to be 60 years old." I think that covers it though. Those are ones I never sell. Speaking of though, chairman and companies that should be in my never sell portfolio if I wasn't stupid and got rid of the position, a stock that we owned 10 bagger ago and didn't appreciate the gains. Spotify, Ryan. Daniel Ek, the founder, is officially stepping down as CEO, moving to chairman and bringing in the co-presidents Gustav Soderstrom and Alex Nordstrom as the co-CEOs. I guess this is essentially formalizing what has already been happening since 2023. Um, they were really in charge of the day to day. He was in charge of broad strategy and capital allocation. It's kind of similar. You look at Nelnet, seems like that is what's happening. You look at IBKR, that's what's happening. You look at even Nintendo with Shigeru Miyamoto, who was kind of the founding of all the brands, the founding developer of all the brands at Nintendo, who is kind of moving to where he thinks he's needed within the company from a broad strategy perspective. It seems like these never sell companies have some sort of founder like character or manager that can kind of evolve with the business and properly set up the leadership for what the business needs to keep succeeding. But when we look at Spotify here, I mean, you put a discussion question down. Is this bad for Spotify shareholders? I think it's kind of a nothing burger. Stock was down a bit, but it's still pretty much a 10 bagger from the lows in 2022.
Yeah, the stock did sell off a bit on the news, but it seems a little bizarre to me. I don't think he's been crazy involved in the operations lately, and he it, in reading his book and kind of learning more about him over the last few years, it feels like he's kind of moved on maybe a little bit mentally from wanting to manage the operations of Spotify. I'm sure he still cares a lot about it and cares about the strategic direction, but
Yeah, he just had a good interview with David Senra on a new Conversational Founders episode, and it did seem like he didn't care about, you know, building the Spotify interface anymore, but there are certain things that are important for their long-term strategy that he wants to have input on, and he's just caring about capital allocation. Now, he said that he's really embraced investing and tried to learn from Munger and Buffett, but I hope that's changed over the last 3 years because capital allocation, their post-IPO period from 2017 to 2021 to 2022, their operating expense discipline is had a little bit to be desired. But hey, maybe they've changed and they're more efficient for the better.
yeah, I think sometimes a severe bear market will teach you to
Can
care
help you,
about cash
green
flow.
you up,
Yeah.
sober you up.
Yeah. Let's shift gears. There were some questions in the chat. I don't know if you want to take any of those, but if not, let's talk about the largest take private deal of all time, Electronic Arts.
First, yeah, why don't we hit this Kuiper one? It was an interesting question. I think that person's waiting. Thank you, Gene, for asking this. Do you think Project Kuiper will become a substantial part of Amazon's business? Given the fact that Amazon is doing 700 billion in revenue, I don't think so. But if they can successfully integrate it into Amazon Prime, I think there's a huge opportunity for them to upsell this. It's quite the risky endeavor. They're investing, I think, $10 billion into the project, and they seem to be significantly behind Starlink. You also have fixed wireless competition, obviously the fiber to the home competitors, all the stuff within internet. I'm not sure exactly how it's going to work. I mean, you even have, the company AST Space Mobile that we had an interview on. There's so many players in this space. I think for Amazon, if you're investing in this company, don't base anything off of Kuiper. If it works and it helps with the business and it helps with pricing power with Prime, maybe that's a nice cherry on top. But I wouldn't think about it as a potential bull case. Ryan, you're a shareholder. Do you think about it any differently?
No, when I think about my position in Amazon, I give little thought to Project Kuiper, honestly, but you make a good point, which is anytime they're making tons of progress in a bunch of small divisions within their company that are never in isolation, most likely going to contribute a ton to the top line or even the bottom line. But what they do is all these small bets, all these small improvements, they bundle it into Prime and make it super compelling for customers. And that's, I imagine, what they would do here as well, potentially. So if they do that, and all of a sudden you can get internet service included, once again, I I think of all the business lines for Amazon, which they have some phenomenal businesses, I think that subscription revenue line will grow double digits for
For a
more
long
than
time?
10
Yeah,
years.
it can grow steadily for a long time. And this was underreported. They are doing a Netflix style password sharing crackdown, which I think could have quite the success given that I'm a not using I'm part of an account that is not using it properly.
Yeah. I think just about everyone is. I am a third derivative moocher off Amazon Prime, I think, if I'm using that right. There are so much Prime password sharing like that has just gone neglected. So good for them. If they can implement that correctly, I they will have probably 50% user growth if they did it today over the next year would be my suspicion.
Yeah, that's fair. All right, other question before we get to EA and then Ackman's letters. Thoughts on Portillo's after the interview? Yeah, if you wanted to, or if you didn't see this week, actually today as we're recording this, we released a podcast with Steven, aka Unemployed Value Degen. He has a good Substack. And he had a long pitch on Open Door, which I thought was interesting from a value and investor's perspective. But we talked a little bit about Portillo's company that has been a dog for me and why he is bullish on them now. I think after the interview, it gave some fresh perspective on why, even though I'm getting psychologically hit or emotionally hit by a 50% drawdown in an investment, he makes it kind of just gives some fresh perspective on, okay, look, the stock is cheap. And if you look at these metrics, blank, 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 it is cheap for a restaurant and it should do well from here, if they can just not have horrendous comp store sales going forward. And I like the pitch. And I think it may be a little bit more bullish as he came in kind of with some fresh eyes on it.
Yeah, I got to admit, after that conversation, I felt compelled to take a startup position. I still haven't, but I would say
A little
that's probably
FOMO.
top.
Got a little FOMO on that value stock. All right. Let's talk
It's
EA
nice.
buyout.
Yeah,
Yeah.
I'll say this. I love, and this is probably a bad investing habit that I have, but when people I know that have followed a company really, really closely for a long time, if I'm able to get a lower cost basis than them, I like doing that,
You're,
even though
you're taking advantage that I bought at 12 and it's at 6.
yeah, but I have I don't have nearly the knowledge on the company or the conviction, but just the fact that I can be like, oh, my cost basis is half of yours feels kind of good.
Exactly, exactly. All right, let's talk Electronic Arts buyout. An old flame of ours that didn't do well, and even I'll say with this buyout, still underperformed from 2020 and 2021 compared to the Nasdaq and the S&P 500. But this is a $55 billion deal. It's funded by Saudi Arabia's PIF, Silver Lake, and Affinity Partners. It's the largest levered buyout ever. Majority of the $36 billion in equity for the deal is coming from Saudi Arabia. It's a 25% premium to EA share price. Deal is $210 in cash. Now, if we look at EA, their stock is up 40,000% since 1989 when they went public, making it around a 400 bagger in 35 to 36 years. If we look at why they did that, good businesses with tailwinds generally win out at the end of the day, even if they make a ton, and I mean a ton, of horrendous acquisitions over that time period. However, it seems like in the video game business, the console business especially, those tailwinds have stalled in recent years. EA has generated only over $2 billion in free cash flow once in a fiscal year. And in the last 6 fiscal years, so going from their last one ended in March of 2025, going back to March 2020, they generated cumulative free cash flow in 6 years of $10.5 billion. So it would take with this deal, undiscounted, at that rate, what would it be? About 6 times 5, 30 to 30 something odd years for them to get their cash flow back. Now there's debt, however you're financing it, whatever numbers they're putting in there. Does I just look at this and I think, was this a good price to pay? I I I think Andrew Wilson and the executive team made a great deal, similar to Bobby Kotick at Activision Blizzard, to get out at a premium.
Yeah, I agree. It I throw EA in the too hard pile because I think a vi- gaming and console gaming and not even console gaming, you can really throw it in with gaming overall has gotten so competitive. I mean, it's been competitive for a long time, but the barriers to development have come down quite a bit. So it feels like it's become more competitive in the last 10 years. The other part is I, there is no community of customers that will give you bigger backlash if you decide to take the private equity approach to running this company than gamers. Gamers will just protest like it's there's no tomorrow. I think they got a good deal. I feel like EA is kind of in no man's land where they obviously have great franchises, but they've just haven't done a great job nurturing them. And it's one of those things where I would have assumed that FIFA and the FC brand over the last 10 years, I think, wow, that's got to be what a great asset to own. But it just hasn't shown up in the numbers.
Yeah. I mean, 10 years, a little bit, but most of the growth was from like the 2014 to 2017 period. The last 6, 7, 8 years, it's not, there's not been much.
I
What's
mean, you would
funny
have,
though, what's
yeah.
funny though is that apparently the Saudi crown prince is a large gamer, which I think is hilarious. And I know that he was just thinking, God, if I could just own this thing, I'll fix FIFA, I'll fix Madden. I don't think it's happening, man. But good
Yeah,
luck.
I wonder. I mean, Saudi Arabia has invested a ton in soccer and football, and I wonder how much of it had to do with affinity for the soccer slash football franchise that EA has, which is the by far the biggest. And I
Yeah,
will
and they've
say,
also invested PIF has invested a lot in video games, so I guess this combination made sense. They're into sports, they're into video games. Let's invest in the largest sports video game company.
yeah, I still goes in the too hard pile because
Oh, yeah.
it's so
Well, at that
biz.
price, yeah.
Wouldn't you have thought that there would just be massive margin expansion over the last 10 years? They've gone from like CDs to pure digital distribution, and so much more of their revenue now comes from live services in the Ultimate Team franchise. It just blows my mind that cash flow's basically gone nowhere for 7 or 8 years. Anyway,
Yeah, not
let's
sure. Not
any
sure.
other topics we wanna hit before we
Let's
sign
do
off here with.
Ackman's letters. We got 5 minutes or so. Why don't you this is your time. Why don't you take us through it?
Yeah, I read Ackman's recent shareholder letter. I think it came out in August,
He
which
does 1 a day on Twitter though.
what's
10,000 word
that?
tweet. He does usually 1 a day on Twitter. If you just
Yeah,
read his
yeah,
tweets.
that's true. Regardless of what you think of Bill Ackman, and there's a lot to, well, I'm sorry, but there is a lot to dislike Bill Ackman if you're listening, because sometimes you get
That's
into
your
topics
general,
that you
Ryan. You
shouldn't.
can't you can't be that's
For
truth
anyone
into
that
your
doesn't know what
general.
we're referring to, he basically went on Twitter and gave a whole bunch of uh, military advice to people in government, and it just kind of, it's one of those things where you get really good in one subject of life and you think it applies everywhere, and I think he maybe took that too far. But he does write a good letter, and I will say if you are an analyst or you're someone wanting to become a professional investor and you want to learn how to write a good pitch, read Ackman's letters because he does a really good job condensing his thoughts and condensing a ton of information into just a few paragraphs for each of his companies. I'll go through his largest positions first, and we can talk about maybe, since we're running a little low on time, which companies you want to actually discuss. And I've got quotes from him on all of them. So, largest position is Uber. Second is Brookfield. Third is Universal Music Group. Fourth is Google. Five, Restaurant Brands International, which is like Taco Bell and Tim Hortons. Six is Amazon. Honestly, kind of
Is it
just
Ta it's not
feels
Taco Bell, but it's Burger King, I think.
Burger
Taco
King.
Bell's Yum! Brands.
You're right. Yeah. It's very similar logos, the two companies. Anyways, uh, seven, Howard Hughes Corp, eight, Nike, nine, Chipotle, and 10, Hilton. Nike and Chipotle, he's got some struggling brands as of late in there as well. Any of these that you want to dig into a little bit?
I'd say either Universal Music Group or Chipotle. Is he buying more Chipotle? Because he bought after the salmonella thing, kinda just held it for a long time. Yeah, either of those seem interesting. Everything else, eh.
All right, let me read you a quote from him on Chipotle. So here, I'll just read this whole thing. While some of the basically he mentions the same store struggles, same store sales have struggled lately. He says while some of this same store sales weakness is clearly due to overall soft consumer spending in restaurants, as evident in the performance of competitor brands, which he is right about. We've talked about that a lot. The onus is on management to adapt to the current environment and better communicate Chipotle's phenomenal customer value proposition We fully expect Chipotle to return to its historical growth trajectory once execution improves and macro headwinds moderate. Do you agree? Do you think there is still a really strong customer value proposition at Chipotle?
Yeah, personally, no, but I'm not everyone. I think it's possible that this is all macro and they'll get their thing, their comp sales will figure themselves out, but they're much more saturated in the United States than I think the company is giving itself credit for. How many people outside of any decently sized metro area can just say, I can get Chipotle fairly easily? Um, yeah, it doesn't get me too excited. The stock, I think, are we down to a PE of 30? Because if so, that's dirt cheap for Chipotle. It is much, much closer than it used to be.
I'm not sure on the valuation. It does, I think $10, $15 for a burrito bowl
It's
is
fine.
still a reasonable, yeah, it's still a compelling value proposition, but I think the quality has come down. Maybe that's just my personal experience, although we've seen reports about
I
it
was
as
early
well.
on this. I've been saying this for 5 years, and
So
I'm not. I didn't short it. It wouldn't have been a good short over that time. But all right, PE trailing PE 35, forward PE according to Fiscal AI's consistent consensus. Uh, Whatever, bringing the consensus onto the platform 30. Nah. What gets you excited about that?
that's going to be a
Yeah.
pass for me.
Yeah. What do you think is the portfolio as a whole?
I think it's gonna get probably close to the market. I mean, a big chunk of this is in Amazon, Google, Brookfield, Uber. I mean, part of it is his portfolio is so large that he has to stick to large companies.
Oh, I don't think this is going to track the market.
You don't think so?
No. I mean, it's 10 companies basically.
There's more. Well, yeah, there is a few more, but there is. Yeah, you're probably right. I like parts of it. He seems to love restaurant concepts and retail more than I do,
Yeah.
but
Yeah.
I I don't he's not the first manager that I like to read letters from, even though he does do a good job of talking about controversial stocks and boiling it down to a few key points. But I don't know. I think the portfolio is a little boring, honestly. I do. The one thing I think is exciting is he has been right about Uber, and he owns it in size.
What's the fund called again?
Pershing Square.
Pershing Square. Okay. Well, yeah. I mean, track record's been solid.
Here's a quote that
Yeah.
I'll give you from
Huh?
his thoughts on Uber. He says, so he talks about basically the threat of automated vehicles and AVs. So he says, and this kind of, I think a lot of people forget that there's been other AV players that are apparently well developed in other countries as well. So he says, recent mobility announcements include new and expanded partnerships with AV Ride, Baidu, Lucid, May Mobility, Momenta, Neuro, Pony AI, Wave, WeRide, and Waymo. He says, over time, we believe that additional data will further demonstrate that partnering with Uber allows AV players to scale faster than they could on their own while maximizing the unit economics of their vehicles. I think that's a fair take. And my belief is that yes, even in an AV future where a couple companies dominate, a lot of people still go through Uber. They have more
Yeah, maybe.
active customers in 5 years than they do today.
Yeah, it's possible. I'm not making that bet though. No, thank you. But it's worked out
Dara's
really
done a
good.
good job turning the ship around.
That's fine. That's
Profitability
fine.
wise.
That is fine. Hey, look, but for the general, it's his largest position, and looks like almost 20% of the portfolio, $3 billion worth of Uber shares. It's done well so far, and I'm sure he knows him and his team know the business better than I do.
Yeah. All right. I think we're running up on time here. We've gone a little long. I can wrap things up here. Anything else you want to add before we sign off?
I don't think so. Thank you to the listeners,
Thank you,
and
listeners and
come ask us
sponsors.
questions. Yeah, come ask us questions every week. We do these live, but the recordings are out Friday mornings.
That's right. And thank you, sponsors as well, Portillo, Fiscal AI, and Interactive Brokers. Let's hit the disclosure. Thank you, everyone, for tuning in. Brett and I are not financial advisors. Anything we say or discuss here on Chit Chat Stocks is not formal advice or a recommendation. We may buy, sell, or hold any securities discussed on this podcast. Thank you, everyone, for tuning in, and we'll see you next time.